İstanbul Finans Zirvesi ikinci gününde ilk panelimiz Merkez Bankacılığı, kriz sonrası ekonomik ve finansal istikrar konu başlığında olacak. Oldukça vakit kaybettik, o yüzden bir an evvel başlamak istiyoruz. Merkez Bankası Başkanı Sayın Durmuş Yılmaz, oturum başkanı olarak davet etmek istiyorum. Buyurun, arz ederim efendim, buyurun. Meksika Merkez Bankası Başkanı Agustin Carstens, Polonya Merkez Bankası Yönetim Kurulu
Merkez Bankası Başkanı gelemedi,
yardımcısı. Tekrar edelim. Polonya Merkez Bankası Yönetim Kurulu üyesi Zbigniew Hochbua, kendisini davet ediyoruz. Brezilya Merkez Bankası Başkan Yardımcısı Luis Avezo Pereira da Silva ve Hindistan Merkez Bankası Başkan Yardımcısı Dr. Subir Gokarn'ı kendilerini davet ediyoruz. Evet, düzeltmeyi de yapalım. Zaten siz önünüzdeki yerde görüyorsunuzdur. Manuel Sanchez, Meksika Merkez Bankası Başkan Yardımcısı. Başkan katılamadığı için kendileri katılıyor. Bu düzeltmeyi de yapalım. Tekrar teşekkür ederim.
We are a little bit behind the schedule, so we have to start. Dear Chancellor of the University, the academicians, dear students, members of Turkish press, media, and ladies and gentlemen. In this session, the title of which is Reassessing the Central Banking, we will be discussing the changing role of central banking and the role of the central bank and the mandate of the central bank in terms of price stability as well as the financial stability, and what sort of financial architecture these changes required. These are the topics which is in flux at the moment. All the international communities are discussing this, and some countries has taken some measures and towards new management and also architecture. But final decision and the verdict of the international community is not given yet. Therefore, jury is still out on this respect. When we look at the last the 15 years prior to the 2007 August, we see that the international central banking implementations had a very benign situation, benign period, in which countries had a relatively stable economic environment, relatively stable and high growth rates, and low inflation rate, and all that. And the question asked then is, and still valid, has this situation were brought about by the prudent macroeconomic and the monetary policy decisions of the central bank? Was it by design of the central bank, or was it by just good luck? Of course, after the crisis, most of the precepts, that drills that the central bank were grown in, especially my generation of central banks, were shattered. Central banks were forced to do things which were not looked well before the crisis. The question now being discussed in the international environment, in the international community, is that what was the causes of the crisis that fell upon us? Was it the wrong central bank policies or the gap in the regulatory and supervisory environment? I attended the Jackson Hole meeting at the end of August, and there was more than 150 academicians, central bank governors, and the representative of the commercial banks and all that. There was a paper prepared by the group of economists and the experts by the Bank of England. The title was "After the Monetary Policy After the Fall," looking into the causes of the problem that we are facing now. Is it because of the central bank policies, low interest rates, or it was due to the gap in the regulation and supervision? Their finding was, of course, that finding is not the ultimate verdict on the situation, but the participants discussed it, was that the crises were mainly due to the gap in the regulatory and supervisory environment. It was not the low interest rates and all that. Of course, immediately there was some objection to it, and the main objective was the Professor Professor John Taylor, who said it is wrong, it is the low interest rate that caused the problem. But of course, if we had a very heated discussion, as I said, no verdict on it, and the jury is still out. And of course, after the crisis, after the 2007, August 2007, and in the ensuing period, and the collapse of Lehman Brothers, and the non-conventional monetary policies that was introduced and put into practice by the major central banks, has brought the world economy to what it is now. And discussion is still continuing. Of course, the situation has changed. Why this central banks' monetary policies implementations has changed? What was the causes behind it? Based on these arguments, of course, the world now at the G20 and IMF, World Bank, and the Financial Stability Board and all that are seeking new rules for the financial system and financial architecture. Lately, Basel Committee has taken a number of decisions, but there are still things to be done. But as I said, final verdict has not been given. During this period, of course, broad consensus, of course, before the crisis, among economists and the policymakers has emerged that the inflation targeting by the central banks lead to a very good macroeconomic outcome. Before the financial crisis, most of the central bank focused on low, stable consumer price inflation and used the short-term interest rates as the main tool to implement the inflation target. Monetary aggregates and the supervision of other prices, such as asset prices, usually played a minor role in the actual conduct of monetary policy. Although the most central banks tackled the issue of systemic risk and banking most of them did not treat price stability and the banking supervision as comprehensive issues. Quite frequently, central banks had to de facto iron walls between the respective departments, or they shared the responsibility for banking supervision with other government bodies. Therefore, today, I have 4 distinguished deputy central bank governors, with whom we are going to discuss the following topics, including their own experiences in their own countries. The topics tentatively are the following, the question that I would raise. Considering the extreme uncertainty of current economic condition, on which side do the central bankers make mistakes? More stimulus or more caution? And second question, as the emerging economies attracting increasing amount of capital inflows, what is the best course of action to address concerns over currency appreciation, excessive borrowing, asset bubbles, and overheating? Another question is, do we think that the crisis may lead to a paradigm shift in the theory and the practice of central banking? In the post-crisis period, what will be the role of central banks in the maintenance of financial stability? What should central banks do to prevent the building of risk that caused the recent crisis? Another topic may be, do we think that the Basel II rules are visionary enough to prevent another financial crisis in the future? And last but not least, do we think that the inflation risk growing in the medium run following the quantitative easing? As the final question that I would like the participants and the panelists to make a comment on is the following. Going forward, what is the biggest threat to the global economy in the near future? What is the likelihood that it will happen? What can policymakers do to make sure that it won't happen? With this introduction, I would like now to introduce the speakers and the panelists. On my very right is the Vice Governor of Reserve Bank of India, and second to him is the Vice Governor of National Bank of Poland. On my left is the Vice Governor of the Central Bank of Brazil, and the last on the very left is the Vice Governor of Bank of Mexico. So I will start with the Central Bank Vice Governor of India. Please, floor is yours.
Thank you, Governor Yilmaz, and let me also thank the organizers for inviting me to speak at this panel. It is clearly a very significant set of issues that you've raised in relation to both what central banks should be doing today and whether what central banks are doing is reflective of a change in the whole framework of monetary policy. So let me address these in 2 separate bits, using the Indian experience as an example, not necessarily as a model, but just as an example. I think just to place this in context, the Indian economy did experience a very significant slowdown. In the first 2 quarters of calendar 2009, the growth rate was at 5.8%, which was the bottom of the trough, compared to an average about 3-year growth rate of about 9.3, 9.4 before that. In the last 2 quarters that we have data for, that is the first 2 quarters of calendar 2010, the average growth rate has been 8.7%. So that is the extent of recovery. And we think that this reflects broadly a return to trend. We don't have a formal statement of trend, but this is a significant return to trend. This means that the economy did not suffer a contraction. It suffered a slowdown, a growth slowdown, but not a contraction. But for us, even a 5.5 or 6% growth is a very large opportunity cost of income growth foregone. So certainly we had great concerns about this, and our policy response was very strong, both on the monetary and the fiscal side. We reduced our benchmark policy rate, which we call the repo rate, by about 400 basis points in the last quarter of 2008. And along with that, some other changes were made. We did not follow any unconventional or non-traditional instruments. We did not see the need to. But having done all this, when the recovery began in the second half of 2009, we found ourselves in a situation where we were very, very far away from what we would consider to be a neutral position. And the recovery was progressing quite well, quite steadily. And inflation started to catch up very substantially. So we moved on headline inflation from very low single digits at the end of 2009 to double digits in February 2010. Core inflation, which we roughly define as non-food manufacturing, take the food element out of it, from negative numbers at the end of 2009 to a peak of about 7% in middle of 2010, June, July 2010. So very, very sharp inflation response, despite the global economy being relatively soft and commodity prices not putting too much pressure. So we had both pressures from food and pressures from the demand side in terms of capacity utilization and so on, which was driving up core inflation. Our response to this was gradual, steady tightening. We felt that the recovery was a bit too early in its progress to be not to be vulnerable to a sharp interest rate action. So we were prone to gradual responses, and we felt the global situation was still very turbulent, still very uncertain, as we saw in May with the European situation developing and subsequently negative news about the US and so on. We basically felt that the balance of external risks was still a bit unfavorable to us, and so the appropriate course of action we felt was steady tightening on interest rates. We've continued with that. We've made done 5 interest rate hikes in the last 9 months, and we think we are sort of close to neutral. We have signaled in our last announcement 2 weeks ago that our normalization of the exit process is close to complete, but inflation remains a concern. It is high, and we want to continue to watch it and will respond to it. We have seen some welcome trends or changes in trajectory of inflation numbers, so that is giving us some comfort, but as a number it still remains high, and we obviously want to try and bring it down somewhat more than we have. We've had concerns about asset prices, partly driven by what was perceived as a negative real interest rate, short-term negative real interest rate. We are correcting that both in terms of raising the policy rate and in terms of inflation numbers going down, and also capital inflows, which Governor Yilmaz mentioned. In the last month, with increasing signs of stabilization globally, capital has started to come in very strong measure, and this has resulted in a sharp appreciation of a currency as well as a sharp escalation in certainly in financial asset prices. So we are now dealing with a scenario that we had to deal with before the crisis, and that takes us to a different level. So overall, the resilience of the Indian economy was driven by 2 factors. One, that the domestic drivers of demand were and remain very strong. It is, as you know from the BRICS classification, one of the economies that is predominantly driven by domestic forces, and those continue to be very strong. Second, I think this is an emerging market generalization. The financial sector was not significantly impaired by the global meltdown. Our banks are still basically banks. They are still basically deposit takers and lenders. Their balance sheet exposures are quite limited, and so the vulnerability that we saw in the banks in the US and Europe in particular to balance sheet shocks because of asset price movements was not very visible amongst Indian banks. So there was certainly a very significant liquidity shock, a liquidity crisis in fact, which the central bank responded to by pumping in very large amounts of liquidity in a short period of time, and we're sort of steadily taking it out now. But that was enough to keep the system going, and really the 2 quarters that I referred to in the beginning were the most negative, and after that things sort of started to come back on track. So we're really now in a situation where we think the crisis domestically is behind us, and we are starting to focus on our longer term issues, of which there are many and keep us occupied. Just a quick comment on the issue of mandate or paradigm. We have begun to think of central banking as a one mandate, a single mandate job, keep inflation on target, or at best a dual mandate, inflation and growth or unemployment. But in practice, as a central bank, I'm new to central banking, so I speak a little bit from an outsider perspective. But when I look back on the way in which the Reserve Bank of India operated, financial stability and external stability were 2 other mandates, which, although not formally laid down, were certainly at the core of many policy actions that were taken by the central bank. On financial stability, our approach typically has been to use higher risk weights associated with certain sectoral lending. For example, real estate prices were booming, and at that point we felt we need to limit or deter bank exposures to the sector. We use that. On foreign exchange, we have in the past intervened to stabilize the exchange rate. For the last 3 years, we have not intervened with that motivation, but as the governor indicated, this is a problem that is starting to engage all emerging market central banks, and it's not a policy option that we are completely ignoring, but we would of course prefer to let the market determine the rate. But there are pressures, domestic pressures coming from various interests, particularly exporters, on this. So when I look at the mandate, the effective framework within which the Reserve Bank manages its mandate, price stability and output stability certainly remain the core. And I don't think there's any debate on this. What was true before the crisis is also true after the crisis. But what was an informal approach to financial stability and to exchange rate or external stability perhaps is starting to get a little more attention in terms of a more formal view and a more explicit statement. It is not yet on the table, but I would say this reflects thinking. So I would say that the new mandate or the new paradigm can be seen as a diagram with 3 concentric circles. The core, the inner circle, is the conventional mandate, price and output stability, whatever weights are given to them. Could be 0 for output and 1 for price. That would be inflation targeting. The second circle is responses or responsibility for financial stability and external stability through instruments that the central bank itself controls. Lender of the last resort, very important function, and reserve accumulation with whatever sterilization or other means are used to offset the liquidity impact. And the third, which is now the basis of much debate both in India and outside, is coordinated action by central banks, other regulators, and the government in terms of dealing with both financial stability issues. We've seen the constitution of the European Risk Board. We've seen a council set up in the US. In India, we are also trying to design a financial stability and development council, which basically is a coordination mechanism which will address issues relating to financial stability, which transcend the responsibility, the current scope of the central bank. So let me stop with that. Thank you.
Thank you. Thank you, Governor. Thank you also very much for inviting me to this interesting conference. I'm very happy to be in Istanbul, this beautiful, beautiful town. Let me begin with a few words about Polish economy, a few basic informations about Polish economy. Because Poland was the only European Union country with a positive growth rate in 2009. The growth rate amounted to 2%. The resilience of Polish economy to the influences of a global financial and economic crisis had several sources. Firstly, limited pre-crisis imbalances, macroeconomic, internal and external, what created a room for maneuver for fiscal and monetary policy when the crisis came. Secondly, large domestic market and attendant limited reliance on exports. The share of exports in the GDP is about 35 to 40%, which is not very much in comparison with other European countries. Thirdly, well-capitalized and profitable banking system. We had no toxic assets. There was no securitization. Was not developed. Fourthly, a flexible exchange rate regime, which was very helpful when the crisis came. And last but not least, lowering policy rate by MPC from 6% to 3.5% and loosening fiscal conditions in the country. I will be talking about that a few words later. So current economic situation in Poland is favorable. GDP growth rate amounted to 3% and 3.5% in the first quarter and 3.5% in the second quarter of 2010. This was possible due to the continued recovery in domestic demand, individual domestic consumption, and build-up of inventories were the main drivers of growth in the first half of 2010. Inflation is subdued. It's about 2% in the last months. There are, of course, some risk to the growth perspectives of Polish economy. As I stated, fiscal policies through a combination of discretionary relaxation and the work of automatic stabilizers has provided counter-cyclical stimulus in 2008-2009. It was one of the factors preventing Poland from falling into recession. General government deficit increased from under 2% in 2007 to about 7% in 2009, and we expect the same in 2010. This loose fiscal policy stance is not sustainable, of course. Polish government is preparing plans for fiscal consolidation. Its goal is to set deficit to GDP ratio under 3% in 2013, and that GDP ratio under constitutional requirements, which is 50 or 60%. Now I want to return to the main topic of our panel and share with you some observations about the relation between monetary policy and financial stability. I will do it. I am at the university, so I try to do it in the university's way. So there will be 3 observations. Observation 1. There is a close interaction between monetary policy and financial conditions, or financial stability, far closer than we thought before the crisis. After the fall of Lehman Brothers, when the interbank money market dried up in Poland, the National Bank of Poland adopted the so-called confidence package and cut in a few consecutive steps the policy rate from 6% to 3.5% that I said earlier. It is the current level of our policy rate. The goal of the confidence package was to provide liquidity to the banking system in the form of repo operation and FX swaps. Although the banking system remained quite stable, we could observe that the worsened financial conditions had deteriorating impact on transmission mechanism and made standard interest rate policy less effective. There is, of course, another relation that means monetary policy may affect financial conditions, especially when holding interest rates low for a longer time stimulates risky financial behavior, excessive risk-taking. But this was not the case of the Polish economy. Observation 2. Although there is a close interaction between monetary policy and financial stability, interest rate policy is not enough to achieve financial stability. I will shortly discuss that issue also on the case of Poland, of FX lending in Poland. Due to many factors, especially relatively high interest rate differential between interbank rates in Poland and abroad, stable appreciation trend of Polish zloty to the summer 2008, high presence of foreign out banks, some of which were early market leaders in FX lending. In 2008, majority of new housing loans were FX denominated loans. The financial crisis has put the high growth of FX lending to an end, so that at the end of 2009, loans amounted to Polish zloty loans amounted to over 80% of newly extended housing loans. However, beginning from 2010, we see a rebound of FX lending. In contrast to previous period, the dominant currency of new FX lending became euro. Earlier it was Swiss franc. From the central bank point of view, the consequences of FX lending is the weakening or even deteriorating of the monetary transmission mechanism. Loans denominated in foreign currencies do not respond in a statistically significant way to Polish interest rate impulses. The other consequences was the build-up of FX exposure in banks and households' balance sheets. This caused, after the fall of Lehman Brothers, increased funding of Polish banks by foreign parents' entities and the need for provision of FX liquidity by National Bank of Poland. In order to prevent building of risk associated with FX lending, the Polish Financial Stability Authority adopted recently the so-called Recommendation T on good practices regarding the management of risk for retail credit exposure. There are plans to introduce quantitative limits on FX loans portfolio. I should also add that Polish MPC, Monetary Policy Committee, is carefully observing the developments on the credit market, although monetary and credit aggregates are not the regards of the National Bank of Poland. National Bank of Poland is, of course, inflation targeter. My last observation, observation 3, is the following. Financial stability policy, that means well-coordinated use of macroprudential tools, could partly substitute interest rate movements. It seems to me that there is a trade-off between using macroprudential tools and tightening monetary policy. As Svensson, recently Professor Svensson, the member of the board of Swedish Central Bank, stated adequate using macroprudential tools would reduce the need for aggressive monetary policy reactions and should in principle be less disruptive to the whole economy than using policy rates. This is obvious in analysis of the Polish FX lending case. I wanted to sum up. I think that there is an urgent need for research on interactions between monetary policy and financial stability, and there is a need for closer coordination between them. But I don't think that in the near future a new paradigm of monetary policy will arise, and I think at least taking into consideration of Polish experiences, inflation targeting appeared to be an effective monetary policy regime. Thank you for your attention.
Thank you, Governor Yilmaz, and thank you for the organizers and the invitation. Thank you, ladies and gentlemen. It's a great pleasure to be here in Istanbul. I think most of my compatriots from Brazil come here either for tourism or to play football, and it's probably more fun than to discuss the future of central banks. But I detected, Governor, a lot of wisdom in your remarks, in the sense that in life we learn from our successes and our mistakes, and central banks are part of, believe it or not, we are living human bodies, and I think one of the big risks is not to precisely observe what happened, this largest, more severe financial crisis since the Great Depression, and not to try to understand what went wrong with it. So the short answer to your very deep questions, Governor, is that indeed I think central banks will have to evolve, maintaining their central objective of price stability, but incorporating the lessons of how somehow financial fragilities were built, and how to address financial stability in global economies, emerging markets, but also mature economies. And why is it so? The crisis probably revealed things that were mentioned probably in many panels here. You mentioned, Governor, the period of great moderation, and how it created an environment that was at the same time extremely helpful for growth, but also to some extent conducive for excessive risk-taking. And I'm sure everybody here knows that there is this extensive literature on how financial fragilities built up during the period of great moderation, why excessive leverage was taken, why some models of risk assessment were not did not take into account the interconnectedness of financial firms, didn't take into account the possibility of black swans, of tail events, triggering a chain of failures in the financial sector that would threaten the overall economy, and with globalized financial world, the overall global economy. So the great moderation per se, although some, as Professor Taylor was blaming the success of central banks in anchoring expectations and creating this very low volatility world for finance, I don't think is here to blame. I think it's more the way in which this very mild environment was associated with a series of shortcomings in the supervision and the regulatory world. What you had is in a sense a regulatory system that was either put aside or was sort of supposed or was worked out with less and less capital required to assume risk. In a sense, if you look at the way some of the constructions of Basel II were made, the essence of the game was to some extent to use less capital to assume more risk, because we thought, or analysts thought, that risk was well precified, well priced, and didn't require to take into account extreme events occurring in the system. So we know more or less the story that happened, and the fact that even if we know that the financial system has an inherent procyclicality, and that has to do with the way in which the macroeconomy functions, you need to have a balanced approach between ensuring that you create conditions for sustained growth and price stability. Sort of the main mandate for central bank is indeed one of these conditions, but at the same time, you observe the financial fragilities, the build-up of excessive leverage, of excessive risk-taking that can disrupt the construction that you have, that you are trying to put together. So we are left now with this sort of this legacy of the crisis, with the lessons of this crisis, and probably a reflection that central banks will have to evolve into considering these two objectives in a balanced way. The objective of price stability as a core, and as my colleagues reminded us, but also the way in which you can introduce instruments to observe, monitor, and preserve financial stability. And this is something that has to do with regulation, supervision, microprudential tools, and it's a little bit more complicated than just what we had at the beginning. And this is why I think what is coming as Basel III, the generation of rules that is coming from the reforms in the Basel Committee, in the Financial Stability Board, and also in many central banks, are very important. The macroprudential rules are not supposed to strangle the financial system, because you can also go from one lax type of rules to the opposite and sort of have a system that is so rigid, particularly for instance in emerging markets that need to have growth and credit markets growing as an engine for sustainable development, that you can sort of fall into the opposite problem. So you need something that assesses better risk, that includes a stronger supervision, that includes a concern about the way in which the system develops systemically important institutions, too big to fail institutions, but at the same time creates a smooth environment for growth of financial markets and of credit markets without excessive risk-taking. Now, the debate, the jury is still out on this debate, and some of my colleagues were mentioning the academic uncertainty on this. You can think of, for instance, an augmented type of Taylor rule for governing the central bank. It means that the reaction function of the central bank will only have, would not only have price stability as at its core, but also some indicator of, let's say, financial stability indicator to react against. If there is excessive instability building up, then there is a possibility for the central bank to react to that. This is complicated stuff, and as my colleague was mentioning, the literature is still open on this. There are trade-offs in terms of the papers by Svensson, by Blinder, on how to calibrate a reaction function from central banks that would take into account the traditional Taylor rule, but also instruments monitoring indicators of financial stability. I think it's also a sort of common sense type of story. When you look at some of the real estate bubbles that are created in emerging markets and in some mature economies, you know that something is happening that has potential negative effects to your economy. If you have very rapid exponential growth of real estate prices, even if we're not capable analytically to precisely identify what is a financial bubble, it's like the elephant story. I mean, it's difficult to describe an elephant, but when you see one, I mean, you're pretty sure of what it looks like. So this is one way to work out central bank reaction functions that have a augmented Taylor rule type of story in its reaction function. The other one, which is I think probably where the consensus is driving us, is to preserving the traditional function, the traditional system that has worked very well, and it has to do with using our short-term policy rate to influence the rest of the economy and keeping, in many cases, inflation targeting regimes, but combining this with a more intelligent type of regulation. And this is where Basel III comes to the discussion. Now, Basel III is something that is slightly more robust than Basel II, and that probably has a different type of spirit. What are we talking about here? You are talking about first having higher capital requirements for bank. It means that essentially when you are strengthening core capital of financial institutions, you are asking owners, shareholders, to have more skin in the game and therefore to assume a more prudent behavior because there is more at stake from their own pockets when they assume risk. Basel III is also talking about liquidity arrangements that are stronger than before. Now, this has to do with resolution in crisis. When you have higher liquidity ratios, you are capable of resolving problems of bank runs and of distrust in some financial assets, and therefore avoid the type of panic selling or fire selling of assets that led to the contagion after Lehman in 2008. You are also talking, if this is not enough, to have a maximum leverage for financial institutions. It means that if the measures listed before are not enough to produce a more reasonable growth of financial markets, then you can cap all this by a leverage ratio. And all this is being done by the Basel Committee and by the Financial Stability Board in a reasonable way, because we know that the recovery is still very fragile, and I think nobody wants to impose rules, as I was mentioned, that are so stringent that they will go against the capacity of economies to recover. So there is a transition period. The implementation is still will be worked out at the country level according to the country's possibilities, but have to be done by January 1st, 2019. So there is a decent but determined period of transition. And then these elements will be put in place that would allow to grow a safer domestic and a safer global financial market. We know also that the rules, the spirit of Basel III that has been sort of reaffirmed by the G20 not only focus on microprudential rules for banks, but also in some other elements that we understood were also part of the crisis. Compensation rules for board members in these financial institutions. They have to take into account the long-term results of the firm and not necessarily short-term benefits that can be offset by big financial crises. They have also to take into account a system of provisioning for losses that is not that is lots more dynamic, that is forward-looking, so that precisely financial firms have the resources to withstand a big shock and not to sort of create a necessary liquidation process or resolution process. And finally, two other things are important. The spirit of these prudential rules will try to examine how to deal with too big to fail institutions. Now, this looks sort of not necessarily applicable to emerging markets like us around the table, but we are sometimes host countries for these too big to fail institutions, and this is exactly what can cause a sudden stop in financial flows. So we are interested in having a regulatory system and prudential rules that make systemically important financial institutions safer for the global economy. And this has to do, perhaps, this is being discussed, with adding an additional layer of capital for these institutions, because they are subject to, because of their size, to larger risks. Finally, it's important to think about information and the financial market architecture. In many cases, crisis, and Brazil was a case in point, happened because of the lack of information, for instance, on over-the-counter derivatives markets. And it's important that everybody engaging in these markets understand what is at stake, what is the exposure of the counterpart you are dealing with, and also that the system works through central counterparty forums and not necessarily bilateral trading that is not really identified and that is not standard. So as you see, I'm listing all these elements because common sense is calling for central banks to both maintain their objective of price stability. I think we've been doing well in this in the past decade, but at the same time adding microprudential tools, supervision, resolvability of financial institutions, rules to make sure that by working our main objective and monitoring what happens in terms of financial fragilities, avoiding financial fragility, is probably a good compromise to have, let's say, a safer financial market at home, but also at the global level to work out with other partners. And most of us, I mean, except Poland, are members of the G20. We are precisely working in this forum to define global rules that are applicable not only to emerging markets, but more importantly to mature economies, so that you have financial growth in a safer manner. So this is what we hope will be, I think, achieved. We are working very hard in a coordinated way at the G20 to make this happen. And hopefully, then we will learn from all these elements so that we can sort of prevent financial crisis of the sort that we lived in the last 2 years. It's not over. I think, as we say, it's not over until it's over. So the recovery is still on. I mean, it's fragile. Many elements of doubt, as was pointed out by the Deputy Prime Minister and the Minister before us here. But at least we have, let's say, the elements of analysis that allows us to understand what happened and to try to avoid, consequences of financial fragilities in the future. Thank you, Governor.
Thank you very much. Now, Vice Governor, it's your turn.
Thank you, Governor. I would like to thank the organizers of this summit, and particularly to the Central Bank of Turkey for the invitation to participate in this event and to share the discussion with such distinguished panelists. Before addressing some of the questions, very interesting questions that you raised, I would like to make a few comments about the Mexican economy that maybe that might be of interest to the audience. Unlike, and unfortunately, unlike this very happy story that my colleague from Poland told you before, Mexico had a very bad experience during the crisis, but fortunately, for the for the first time, maybe in many, many years, this time wasn't our own fault. It was totally somebody else's fault. It was a result of bad luck. It is not easy to say that in the history of the Mexican economy, but for the first time, I'm able to say that with all safety. And let me tell you just that, remind you that we are very much linked to the US economy for better or for worse. And we were subject to, among other shocks, to 3 very important shocks that were very difficult to avoid. One was the natural shock of, this sudden stop of capital inflow, particularly from the US, that were reflected in a very sharp depreciation of the peso vis-a-vis the US dollar. As you know, our currency floats. It's a totally floating exchange rate regime, but we had a very, very sharp depreciation that introduced a lot of uncertainty. Later on had some stimulus for exports, but in the short term, it was only had a very negative effect on expectations, and that was the first shock. The second one was a fall in the oil prices, which although oil is not important for the balance of payments of the country, oil revenues for the public finances represent around 35% of total revenues, which make the public finances very, very fragile. So that was the second shock. And the third shock, which was particularly very important for the real economy, was a very sharp contraction of the U.S. manufacturing production, which has almost a correlation of close to 1 with our manufacturing production through the U.S. demand for our exports. So all these 3 shocks had, as I said, an important effect in the financial markets. We, in the central bank, responded with transitory measures for providing liquidity, perhaps similar to what India did. It was a transitory phenomenon, so we included some swap lines with the Federal Reserve and some provisions that banks did it, but that lasted just a few months. At the same time, at the beginning of last year, we started, reducing the policy interest rate around more than 300 basis points all the way to 4.5%. That's the level that we have right now. And at the same time, during the last part of 2008 and the first part of 2009, the fiscal authorities implemented some counter-cyclical measures. However, as I said, because of the oil constraints, and because the fiscal ministry has been very responsible, and the bad experiences we had in the past with large fiscal deficits, in order to maintain a small fiscal deficit, the counter-cyclical fiscal policies were relatively limited. And the result was a sharp contraction of GDP. We fell 6.5%, sorry to say, but that was the reality. Fortunately, this year, the economy will probably grow around 5%, partly recovering the territory that we lost. It's just a part of the recuperation. We are expecting a little lower growth next year. And what I would like to say at the end is that the banking system was about one of the few pieces of the economy that remained extremely resilient, and that wasn't also that wasn't a casual result of pure luck. And like what I said before, because we had an important crisis in the mid-1990s, Mexico strengthened its regulation and supervision for the financial system. So this time, the regulatory and supervisory framework happened to be just right for having the banking system ready to such a shock. And even customers, I mean the society in general, and the new bankers, because as you probably remember, we opened the banking system for foreign investment, and there are new bank managers and new bank owners after the crisis that we had in the mid-1990s. And this new management, given the crisis that we had, actually showed better, much richer expertise in providing sound credit products and more a better management of risk. So everything seemed or everybody seemed to have profited from the previous crisis, so we didn't have any problems with the banking system. Notwithstanding this success, we are conscious that we have to strengthen the regulatory and supervisory framework of the banking system, and actually we are just forming a new financial stability council in order to foresee or to supervise the overall situation of the financial system, and to implement, through the different authorities, the proper macroprudential measures that the economy might need in the near future. Now, let me just make a few comments about a couple of interesting. All the questions were very interesting, but I would like to choose one of the two of the questions that you raised, Mr. Governor. One is related to a possible change in the paradigm of the central banks. And I would like to say something that I said yesterday, is that it is customary nowadays to hear some criticisms about the way we have been handling the monetary policy. It has been rather frequent to hear that our strategy of inflation targeting has been insufficient or has been too narrow to accomplish whatever was expected from a central bank, including the financial stability objective. And I think that criticism is not well founded. It's not doesn't have much ground. One has to distinguish between the remarkable achievement that the world in general and the inflation targeters in particular have attained at fighting against inflation and conquering that evil that was an important malady of our economy just a few years ago, not too far in the past. So inflation targeting in any kind of strategy that has proven to be effective has given all the credit, and I think there should be no reversal regarding these commitments of central banks at fighting against the inflation. Certainly, one has to distinguish another part, that is, central bankers have to recognize with enough humility that did not foresee the crisis coming, and that wasn't not only the fault of the central bank, but also the fault of almost everybody in society, which happens to be almost a precondition for a bubble, for instance. A precondition for the gestation of a bubble is that everybody underestimates the risks, and this time supervisors, including the central bankers, underestimated the risks. So that lack of timely detection of the risks should be recognized, and anything that help may help in the future in order to detect risks should be taken carefully and seriously in order to do a better job in the next time. Certainly, certain factors perhaps helped or helped to explain why we missed important parts of the formation of the crisis. One is perhaps for the central banks, it's perhaps their own methodological limitations. Although I don't know how much that influenced, but in our case, for instance, the models we use for monetary policy decisions typically don't incorporate the financial sector, which happened to be the heart of the very heart of the crisis. Or we don't. That's a typical of any model of monetary policy. We are not good at incorporating the tail risks. Something that we have to somehow formalize in our decision making, and that's probably part of the reason why we missed the symptoms of the crisis. And on the part in general for all regulators, I think that's another part of the reason why we missed the crisis or the symptoms of the crisis is that perhaps we were too much concentrated into a micro regulatory approach that is just supervising bank by bank or a financial institution by financial institution without looking at the interconnectedness of those institutions and the connection between the institutions and the different markets. Let me just say one more comment, and that is, in order to foresee a better management of or a more preemptive kind of approach for any future crisis, I think it is very important to make additional progress at understanding the causes of the previous one. It is the study that the governor just mentioned from Jackson Hole is an important contribution to understanding the sources of the crisis. As he very well explained, there is a debate on that. Fortunately, one would like to have, ideally, a set of sufficient conditions such that once we handle those conditions, we will be able to avoid any crisis. But unfortunately, any list of possible causes either is bound to contain very general conditions, or if you want to be more specific or more practical, then it's very likely that you're going to end up with a very incomplete list. So, but that doesn't preclude you to the duty of, further understanding. If Mr. Taylor has some sort of reason in that, how much loose monetary policy played in the gestation of the crisis as a role of a possible cause. Everybody knows that the crisis wasn't a result of one single cause, but one has to be prudent and understand the kind of monetary policy that do not facilitate future crises, even though monetary policy may not be the main course in the future. It is important not to be to facilitate instabilities in the future, and also it's important that any financial policy for the promotion of credit or any structural hole that we might have in our regulatory framework to be avoided. Let me just end with the recommendation that look at the structural problems of our financial system. I think the Basel III initiatives are very, very important steps in the right direction. We need very strong financial systems, and that requires the adequate incentives of market players and that has to do with all those capital requirements, liquidity requirements, and also expedient mechanisms for providing liquidity in case of solvent institutions that need liquidity, but also important, expedient mechanisms for resolution of important institutions, so that the possible moral hazard that usually comes with the too big to fail policy is minimized as possible. Thank you much.
Thank you. Deputy Governor, I see that the panelist of the next session has arrived. May I ask the organizers, as we are behind the schedule, how much time do we have? Sorry? Quarter. 15 minutes. Okay, thank you very much. At the beginning of May this year, when the major central banks were about to announce their exit strategies, suddenly the emergence of the problem, especially the European banks, forced them to postpone the exit strategy. And also in the ensuing period, the development in the real economy in the United States also led to have a second thought about the exit strategy by the Federal Reserve. None of the banks, central banks around this table, has introduced non-conventional monetary policy implementations during the crisis. But at the moment, discussion is still continuing whether the central banks should exit or continue the policies that they have already implemented. And there is a debate going on at the moment. As for the Central Bank of Turkey, and for Turkey, we have decided to exit. And we, in terms of the fiscal policy, we decided to exit in September last year, and also we announced our exit strategy on the 14th of April this year. But on the whole, this exit strategy is still, debate continues. May I ask the colleagues, if the central banks should make a mistake, should we make the mistake on the side of stimulus or on the side of caution?
I think the response to the crisis was clearly synchronous, coordinated, based on a universal recognition that if these actions are not taken, we could be entering the next Great Depression. When the G20 met in Washington in November 2008, the sense of impending doom was very clear in the statements, in the actions that followed. But the nature of the recovery has been extremely asymmetric, extremely uneven. The same actions taken by various governments have resulted in very different responses, partly in response to the actions themselves, but partly also because of circumstances peculiar to each country. So from the perspective, or from the Indian perspective, I would say that the threat of inflation has clearly now outweighed the threat to the recovery from exit and from normalization and from taking anti-inflationary stance. This has been visible for the last few months, that the growth impulse is looking at least more and more stable, more and more persuasive, and the inflation risk is looming, or did loom, that much larger. So I think the issue of caution in terms of moving towards a more and more pronounced anti-inflationary stance, at least from the Indian perspective, was clearly warranted by the fact that the recovery looked stronger and stronger. So from our perspective, I would say caution over stimulus, but based on the confidence or growing confidence about the strength of the recovery. I am not advocating a universal proposition because different countries have very different circumstances.
As far as Poland is is concerned, we have in some sense also used non-conventional measures, but we stopped to use them just a few months ago, so it was our exit strategy. If I should add something more general, I would say that the central banks, especially the Central Bank of United States, the Federal Reserve, and the European Central Bank should and really does it balance the risk. And it is very difficult to say just at this moment what the central banks will do in the near future, especially as the Federal Reserve is concerned. We could read in the last comments of Bernanke and his colleagues that they will probably they will observe the development of the situation and introduce additional measures if it will be needed. So I wouldn't like to say definitely what is the best solution.
Quickly, Governor, we also were facing overheating, so we removed essentially our stimulus both on the fiscal side and monetary side early in 2010. I think everybody here was facing the same dilemma. Many analysts were accusing central banks to be behind the curve at the beginning of 2010 because inflation, expectations of inflation were running up. And we have to sort of be very subtle about the fact that you did have a V-shaped recovery that was creating this overheating, but at the same time we had to observe the trends in mature economies and see if the recovery there was going to be sustainable. And it proved not to be so. I mean, it proved that the turning of the first half of 2010 to the second, that Japan, the US, Europe started showing signals of deceleration. So on the emerging market side, we had to take action because we have credibility at stake. We had to sort of look at our own indicators and observe what was going on, and we did so, and Brazil was a case in point, and took action. But at the same time, we were in a situation where, as was mentioned here, but not perhaps enough discussed, by taking action in a situation of very low growth prospects in the mature economies, very high interest rate differentials, and rising because we were on our side tightening monetary policy, we created an environment that was conducive for the acceleration of carry trade and additional capital inflows into our own economies. We were the only game in town. We were the economies that were growing on a sort of nice and buoyant way, and that was attracting a lot of attention and a lot of flows in search of yields. So the dilemma for the global economy is, as the governor put, not only what, how, and when central banks in mature economies will take action to relax or to continue, to sort of continue the unconventional policies, but at some point in time they also will have to act. But can we, at the emerging market side, sustain a tightening of policies because of the development overheating in our economies while the rest of the world stays put, with the consequences that we are facing now, the possibility and the continuous appreciation of currencies, and also on our markets, the emergence of signals of credit and financial pressure upwards. So this is the dilemma. I think it's broader than the individual capacity of each of us to act alone, and that is why it is important first to discuss among ourselves, but also to discuss in forums like the G20, where there is a bit of a coordination between emerging markets and mature economies, so that we can collectively decide a best outcome for the global welfare.
Thank you. Please.
In speaking about unconventional monetary policies, that brings to my mind only or mostly advanced economies. So we wouldn't be talking about Mexico in particular in this case. Unconventional monetary policies, for instance, in the United States, come with two elements. One is the fear of deflation, and two, a long history of very good result in terms of price stability. Given those two elements, I will dare to forecast, not to advise, but forecast that the US Federal Reserve and the other important central banks of the developed world will prefer to err on the expansionary side than to be on the other side. That will be my forecast. Now, speaking about Mexico, we have a different situation. We didn't have any important nor any permanent unconventional monetary policy. As I said, it was very, very transitory, and we didn't expand our balance sheet at the central bank. So we don't have that kind of a problem. We did have a very important shock in terms of the real economy, and as I explained to you, we managed a reduction in interest rates that happened to result in ex-post negative real interest rates, which along with the sharp depreciation of the peso, we thought it was almost anything we could reasonably do in order to provide some caution for the recession. But we are very conscious that the recovery of our economy depends very, very largely on the fate of the U.S. economy, and therefore the Central Bank of Mexico would like to prefer err on the conservative side, because we have still a long road to converge to our inflation target.
Thank you very much. Of course, there are many important questions to be discussed, and some of which I have raised in my introductory remarks. But because of the time constraint, I am not going to ask a second question. But in order to make the session perfect, I would like to have one question only. If there is one, then we will finish. Please. Okay. Anyone wants to respond?
I think the prudent principle would be that you look at the risks that are building up in the financial system as a result of rising house prices. I think the demand-supply fundamentals of house prices clearly are something that need to be taken into consideration. And the issue is whether prices are being driven by so underlying structural factors such as rising affluence and rising affordability, as well as the transition of people from rental arrangements to ownership. So I think it's home ownership is a very positive force, I think. But is this being driven by something beyond fundamentals, which is aggressive lending practices, very low or very high loan-to-value ratios, which are then tending to build up risk in the financial system? So I think those are the considerations that go into this. And the Indian experience, which I referred to in my remarks, really focused on the risk aspect, tried to rein it in by increasing risk weights to real estate exposures, not residential but commercial, residential also I think, but commercial and residential both. And that's the way we've seen this, or we've seen it as a balancing act between the need to sustain this process, a fundamental process of increasing home ownership, with trying to prevent excessive build-up of risk, or build-up of risk, not just excessive, but any build-up of risk. The Indian environment is perhaps similar to other emerging markets in the sense that our loan-to-value ratios typically are quite low. Say just as a rough estimate, around between 60-65%. So, and home prices rarely go down, and if at all, never by that proportion. So, homeowner equity is typically positive for the life of the loan, and so risk build-ups are relatively low. But there are, of course, concerns about very sharp increases in prices, and I think that's something we keep a watch on from a prudential perspective.
One, I mentioned the academic possibility of augmented Taylor rules for central bank reaction functions. One of the indicators of financial stability could be prices of assets, and particularly of real estate. Now, as you may know, as you know, this has also some impracticalities, because if you want to sort of react simultaneously with one instrument to these two sets of prices, consumer prices and asset prices in one rule, then you end up with sometimes very impractical reactions for your short-term interest rate. So that is why you have a sort of this quarrel in academia and among practitioners about if it is realistic to observe housing prices and then to incorporate that into a reaction function of central bank, and that the whole thing works as nicely as under the traditional inflation targeting regime. So that is why the practical solution would rather be to continue under the current framework, but having to adding prudential rules, macro-prudential rules, in particular directed to credit markets related to real estate, that would sort of monitor, including through monitoring prices, but monitoring also risk, activity, and so on and so forth, what is going on in this very special market.
Thank you. One minor addition to my colleague from Brazil, there is an additional complication of incorporating asset prices into the reaction function of the central bank, and that is, if you want to target asset prices, then it's going to be very difficult not to react to the fall of asset prices, which then will turn to be a sort of a subsidy for investors, and then could become a very messy situation in terms of incentives for the market players.
Another practical problem would be, for example, for the Federal Reserve, that asset prices, housing prices in various parts of the country develop not in the same pace. Professor Laser just told yesterday that this is practically impossible to introduce into the reaction function of the Federal Reserve asset prices because of that issue.
Well, thank you very much again. If I may summarize in one or two short sentences of the deliberations that we have made here today, the result is the following. So far as the mandate of the central banks are concerned, the price stability is still the main mandate, and it is intact despite what has happened to the global economy. And the second, the lessons that we should take and we should act upon is the financial stability is as important as the price stability. Therefore, from now on, it is the job of central bankers, practitioners, academicians as well, how to incorporate this into the central bank's objective function, probably into the price stability models and all that. I believe in the time to come there will be lots of literature on this subject. As for the financial stability, that the central banks who has the responsibility for regulation and supervision thinks that they are in need of going into deeper and having a micro view of the situation. And for the central banks who does not have any responsibility for banking regulation and supervision, I think the developments necessitated that they should pay more attention for the financial stability. Of course, this raises the question of coordination. If these two functions are in the separate bodies, I think this is very important. This should be the main agenda of the central banks, to have a common ground and to have a coordination. This is, on our part, the main task of the central bank in the time to come. With these words, I conclude the session, and I invite you to have a big applause for the participants, the contributions that they have made for the panelists. Thank you.